WTI crude futures maintained their recent gains at around $75 per barrel on Friday, driven by increasing optimism that the U.S. Federal Reserve might reduce borrowing costs twice this year, fueling a rally in risk assets. This optimism followed weak U.S. jobs data and the European Central Bank's first interest rate cut in 5 years. Investors are now eagerly awaiting the monthly U.S. jobs report, due later today, for more insights into the Fed's monetary policy direction. A weaker job market can reduce consumer spending and industrial activity, potentially lowering oil demand and prices. Despite this, oil prices are set to decline for the third consecutive week due to concerns about a potential supply surplus following the latest OPEC+ decision. OPEC agreed on Sunday to extend most of its supply cuts into 2025, but announced plans to gradually phase out some voluntary output cuts from 8 member countries starting in October. Russian Deputy Prime Minister Alexander Novak attributed recent price drops to misinterpretations and speculative activities. Meanwhile, Rystad Energy analysts predict OPEC+ will continue managing the market and may introduce further cuts if demand softens. I believe the combined efforts of Russia and Saudi Arabia will keep oil prices in the $75 to $80 range over the longer term. Given the anticipated rise in supply from OPEC+ and mixed signals from economic indicators, the short-term outlook for oil prices remains bearish. The technical trend indicators remain bearish despite a 3-day short covering rally. This movement did not break any significant resistance levels and was likely driven by oversold conditions. On the downside, a move below the $75 threshold has opened the way to the test of the nearest support at the $74 level. If it fails, a trade through $73 will signal a resumption of the downtrend with $70 as a potential target. Please like and comment to support the channel. See you in the next one.